This is On the Charts with Nick Radge, your Australian stock market update, highlighting stocks on the move so that you can invest with confidence and success.
The information in this podcast is general advice only and does not take into account your personal situation. Please consider if it is appropriate to you and consult a licensed professional before making any investment decisions. The information provided is believed to be accurate at the time of recording.
Welcome to the On the Charts podcast, episode 184 for Thursday, 27th of April 2017. US markets traded slightly higher early in the session but gave back the minor gains after the Trump administration released a one-page blueprint on its expected tax plan. The document was very broad in nature and omitted key details. What is clear is that any implementation, should it even get through Congress, will blow out the budget considerably. Earnings season continues to roll along in the US, and US Steel was a casualty last night after its shares dropped over 26%. This is after the company announced a surprise loss and downgraded its outlook. The sharp move was the largest single-day decline in the company's 26-year history. In other news, the ECB meets tonight, but no change in policy is expected, and the Aussie dollar traded well lower overnight through the 75-cent level of support. Scott Goddard, author of the Global Chart Research Service, has been taking a cautious stance on the Aussie, although technically he can see some upside scope should momentum take centre stage again. Against the US dollar, it's stuck in the steadfast range, but based on the fundamentals may head slightly lower during the remainder of 2017. A lower dollar may need to be driven by the Reserve Bank. Theoretically, a decline in commodities without a similar decline in the currency is effectively a tightening in financial conditions, indicating a slowdown in growth. Consensus is for interest rate settings to remain unchanged as the RBA is stuck between rising property prices and household debt on one side and weak employment and subdued inflation and lower wage growth on the other. Considering the long-term neutral stance the RBA is faced with, any further tightening in US rates by the Federal Reserve should or will weigh on the local currency. Technically, the line in the sand is around 73.80. Below that points to a move down towards 69, and above 73.80, a glimmer of bullish hope remains, but it would really need to thrust back above 76.20 to get going. Last night's decline placed the longer-term momentum in a deep oversold position, but also put the short-term momentum in a bullish divergence position. Now, the combination of these two is quite potent. The last time we saw these two combined was back in March, albeit in reverse, and since then we've seen the Aussie dollar decline from above 77 cents down to current levels, so certainly one to watch. On the ASX today, Santos said it will supply more gas into the domestic market than it purchases for export, and this comes after the federal government intervened to avert an East Coast gas crisis. Shares in Santos and other energy providers slumped. Energy Resources fell 6%, Santos declined about 5.9%, and Origin dropped 4.4%. Qantas rose 4.5% after Macquarie Bank suggested the company could start a $500 million buyback, and Wesfarmers fell after earnings update. It announced Coles had posted a slowest growth in the last 9 years. At the close, the ASX was slightly higher with gains coming late in the session. Yet again, banks offered the broader index support, rising between 0.5% and 1%. And as mentioned above, Qantas jumped today, posting its highest close since 2008 and driving through major resistance set back in early 2016. Many analysts have got Qantas completely wrong over recent years, many taking the common line of Warren Buffett, suggesting airlines are just too hard to run and do not make any money. Indeed, it wasn't that long ago that some were touting the company would actually fall over when it went from a loss of $2.8 billion in 2014 to a $1 billion profit in 2016. However, doubts still linger, even though the share price has risen from a $2.50 recently to today's highs of over $4.20. Analysts cite the expected reduction in oil supply should lift oil prices once again, which will obviously hurt the company. Also, domestic capacity is expected to remain flat or even fall slightly, and increased competition from Asia is a concern. Technically, however, the upside momentum is extremely strong, and we see considerable upside yet to come. The pattern progression does suggest a near-term overextension, so we wouldn't be surprised to see a pause or some kind of consolidation sooner rather than later. And if that consolidation takes place above this new support level, all the more better, and it would certainly provide a very low risk opportunity. Bigger picture, we can see a $5 handle over the next 6 months and then considerably higher beyond that time frame. The ASX and Global Chart Research Services offer in-depth technical analysis on over 120 Australian stocks, global indices, commodities and FX pairs, and help you make better informed decisions. Membership also provides you access to an array of technical courses to further your own education. Just hit the trial button and you can start immediately. My name is Nick Radge, and I'll see you on the charts tomorrow.
On the Charts with Nick Radge, brought to you by The Chartist. Join Nick and the team at Noosapalooza Trading and Investment Conference, 20th and 21st of July in beautiful Noosa, Queensland. Visit thechartist.com.au and click on Noosapalooza in the menu for details.